Wall Street does not want you calm. It wants you excited, nervous, impatient, and convinced that the next big move is always one trade away. Because when you are calm, you ask better questions. And the most dangerous question an ordinary investor can ask Wall Street is simple: why am I paying you so much? For decades, investing was sold like a private club. Experts, managers, brokers, analysts, secret research, exclusive access. The message was clear: you are not smart enough to do this alone. Then one stubborn man looked at the whole machine, did the math, and realized the expert class had a problem. Most of them were not beating the market. They were just charging people for trying. His name was Jack Bogle, and he did not create a flashy trading strategy. He created something more dangerous to Wall Street, a cheap, boring, mathematical rebellion. This is the story of how one idea changed investing forever, not by promising to beat the casino, but by showing millions of people how to walk away from the casino. Before Bogle, the investing industry operated like a casino with better suits. Investors placed bets, managers made promises, brokers collected fees, and the house always found a way to get paid. That is the first truth. Wall Street can make money, even when you do not. It can collect commissions, management fees, trading spreads, advisory fees, and tiny costs you barely notice until decades pass. Individually, those fees look small. 1% here, 2% there, a little trading cost, a little advisory charge. But investing is not a one-year game. It is a compounding game. And in a compounding game, small leaks become giant holes. That is the math Wall Street did not want ordinary investors staring at for too long. Bogle's revolution did not begin in a skyscraper. It began in a library with a young Princeton student reading about mutual funds and asking a question almost nobody in finance wanted asked. What if mutual funds were supposed to serve the investor first, not the manager, not the broker, not the salesman, the investor? In his senior thesis, Bogle argued that funds should operate economically and honestly. Even more dangerous, he suggested they could not honestly claim superiority over the market averages. That was a quiet bomb, because the entire active fund business depended on one sales pitch: give us your money and we will do better than average. After Princeton, Bogle joined Wellington Management. It was conservative, balanced, and old-fashioned. Not exciting, but it was disciplined, low-cost, and serious. Bogle later compared Wellington to a shop selling nutritious bagels. Not glamorous, not sweet, not addictive, but useful, stable, sensible. Then the 1960s arrived, and Wall Street discovered sugar. Speculative funds exploded in popularity. Investors did not want nutritious bagels anymore. They wanted donuts covered in performance promises. The go-go era rewarded speed, aggression, and storytelling. Everyone wanted the hot fund, the star manager, the next miracle. Bogle felt the pressure to compete. And here is what makes Bogle's story honest. He did not begin as a perfect prophet. He made a terrible decision. In 1966, he merged Wellington with flashy managers running aggressive growth funds. It looked like a way to survive the new Wall Street. Instead, it became the mistake that nearly destroyed his career. When the market turned, the aggressive funds collapsed. The sweet donut shop caught fire. Performance vanished. The people Bogle partnered with turned against him. Then came the humiliation. Bogle was fired from the company he had spent his adult life building, but losing power gave him something more valuable: clarity. That is the turning point. Some people get fired and try to rejoin the same game. Bogle got fired and started asking whether the game itself was broken. In 1974, he convinced the Wellington board to let him form a new company to handle administration. He named it Vanguard, after a British naval ship. The name mattered. Vanguard means leading from the front, but the structure mattered more. Vanguard would not be built like a normal Wall Street firm. Traditional financial firms are built to make profits for owners. Vanguard was built so the investors in its funds effectively owned the company. The savings could flow back to them. This was a quiet structural revolution. Bogle was attacking the industry not with a louder sales pitch, but with a different incentive system. If the company did not need to enrich outside owners, it could lower costs. And if costs fell, more of the market's returns stayed with the investor. That sounds simple now. At the time, it was almost heresy. Wall Street was built around extraction. Bogle was building around subtraction. But Vanguard had a problem. It was not allowed to actively manage money. So Bogle needed a product that was not active management. Something almost too simple to respect. The idea came from arithmetic and academic research. If most active managers fail to beat the market after costs, then why not simply own the market at the lowest possible cost? That was the index fund. No stock picking, no star manager, no expensive guessing. Just buy the companies in the index, hold them, and keep costs brutally low. To Wall Street, this sounded insane. The whole industry was built on the idea that someone smart could pick the winners. Bogle was saying, stop paying people to search for needles, buy the haystack. In 1976, Vanguard launched the first index mutual fund for ordinary investors. The underwriters expected serious money. What they got was embarrassment. They hoped to raise hundreds of millions. The fund raised only a small fraction of that. Wall Street mocked it as Bogle's Folly. That name was supposed to be an insult, but history has a sense of humor. Some of the best financial ideas start by looking stupid to people who profit from the old system. The index fund did not need applause. It needed time. And time is exactly where low costs become deadly. Bogle called it the relentless rules of humble arithmetic. Not a secret formula, not a trading signal, just basic math repeated over decades. Here is the math. Before costs, all investors together must earn the market return. After costs, investors as a group must earn the market return minus what Wall Street takes. That means costs are not a side issue. Costs are the issue. They are the gap between what the market gives and what the investor actually keeps. Imagine the market returns 7% a year. A high-cost fund takes 2% through fees, trading, and friction. Now, the investor keeps 5%. In 1 year, that looks annoying. Over 50 years, it becomes brutal. 2% does not just reduce your return, it compounds against you. That is the trick. Investors understand compound growth when it helps them, but they often ignore compound costs when it quietly destroys them. Wall Street was selling the dream of outperformance. Bogle was selling the reality of keeping more of what the market already provides. That is why the idea was so powerful. The index fund did not need to find the next great stock. It owned the winners, the losers, and the whole messy market in one basket. If one company failed, another could rise. If one sector cooled, another could heat up. The investor did not need to predict the future perfectly. They just needed to own the broad engine of capitalism. This is psychologically difficult because average sounds insulting. Nobody wants to be average. But in investing, average before costs can become above average after costs. That was Bogle's genius. He turned average into a weapon. He made boring competitive. He made patience practical. Active managers could still win in any single year. That was never the argument. The argument was that, as a group, after costs, they could not all beat the market they collectively owned. Someone can beat average. Everyone cannot. And the more everyone pays trying to beat average, the worse the group result becomes. This is the casino problem again. The players can fight each other all night, but the croupier does not need to predict the winner. He just keeps collecting from every hand. Bogle's index fund was like refusing to play table games and buying a piece of the casino's long-term economic growth instead. But Wall Street hated it because it threatened the story. If investing could be simple and cheap, then expensive complexity looked less like expertise and more like theatre. That is why the criticism was so emotional. Passive investing was called lazy, un-American, foolish. But insults are often what an industry uses when the math is not on its side. Slowly, the evidence began doing what evidence does. It kept showing up. Year after year, low-cost index funds became harder to dismiss. Investors started noticing. The miracle manager was hard to identify in advance. The fees were easy to identify immediately, so they voted with their wallets. Money began moving. Slowly at first, then faster. Expensive funds started bleeding assets, while Vanguard's low-cost index funds grew from a joke into a movement. This is the part Wall Street never understood. Bogle was not selling excitement. He was selling relief. Relief from guessing, relief from chasing, relief from wondering if your manager was brilliant, lucky, or just expensive. The index fund gave ordinary people a clean answer. Own the market, keep costs low, stay diversified, and let time do the heavy lifting. No, it does not promise you will get rich overnight. That is the point. It removes the fantasy and leaves the mechanism. And the mechanism is powerful because capitalism is messy but productive. Companies compete, fail, adapt, merge, innovate, and grow. The index fund lets you own the system instead of betting on one hero. That is why Bogle's idea became enormous. It was not because investors suddenly stopped wanting wealth. It was because they realized the quiet path often beat the expensive path. Over time, Vanguard grew into one of the largest asset managers in the world. The tiny fund Wall Street laughed at became part of a $1 trillion shift in investor behavior. The real victory was not just size, it was pressure. As index funds grew, the whole industry had to respond. Fees fell, competition changed, investors gained power. That is how a boring idea becomes revolutionary. It does not need to burn the system down, it just forces the system to stop overcharging people in silence. Bogle did something rare in finance. He built a company that could have made him much richer if he had structured it differently. But he chose the investor-owned model. That choice cost him personal wealth, but it created massive value for everyone else. In an industry built on taking a cut, that is almost suspiciously honorable. He was not anti-capitalist. He was anti-waste. He believed investors deserved the market return without having so much of it skimmed away by financial middlemen. That is a very different kind of rebellion. Not loud, not flashy, just a calculator, a cost table, and the courage to tell Wall Street its expensive magic trick was mostly fees. Warren Buffett later praised Bogle's contribution to investors, arguing that few people had done more for ordinary Americans trying to build wealth. That praise mattered because Buffett understood the same principle. You do not need constant motion to build wealth. You need ownership, patience, discipline, and low friction. But Bogle also warned investors about behavior. An index fund can solve the fee problem, but it cannot stop you from panicking at the worst possible moment. That is the uncomfortable truth. Low-cost investing is simple, but simple does not mean easy. The hard part is staying with the plan when every headline tells you to run. Wall Street sells activity because activity feels like control. But sometimes the best financial decision is not another move. It is refusing to make a bad move. This is why Bogle's message still hits hard. The industry will always invent new products, new trends, new reasons to trade, and new fees hiding behind new language. But the old question remains undefeated. After all the promises, all the strategy, and all the complexity, how much of the return does the investor actually keep? That question cuts through almost every sales pitch in finance, because a good story can make you excited, but arithmetic decides what stays in your account. The $10 trillion idea was not that markets are always safe. They are not. Markets crash, stocks fall, economies break, investors suffer. The idea was that if you are going to take market risk, you should at least stop donating so much of the reward to people who cannot reliably beat the market for you. That is the brutal fairness of indexing. It does not promise fantasy. It offers exposure, diversification, low costs, and humility. For most people, that was more useful than another genius manager. Bogle understood that ordinary investors did not need to win cocktail party arguments. They needed a system that could survive jobs, families, recessions, panic, and time. And that is where the index fund quietly changed society. It gave regular workers access to a diversified ownership machine that used to feel reserved for insiders. It turned the stock market from a game of stock-picking performance into a tool for long-term wealth participation. That does not make investing effortless. You still need income, savings, discipline, time, and emotional control. But it removed one major obstacle, the need to constantly outguess professionals. Bogle did not make investing perfect. He made it less rigged against the person paying the bill. That is why his legacy is bigger than Vanguard. It is bigger than one fund. He forced an entire industry to explain its costs. He made people understand that the investor's return and the market's return are not the same thing. The difference is what the system takes. Once you see that, you cannot unsee it. Every fee becomes a question. Every product becomes a trade-off. Every promise has to survive the arithmetic. That is the power of financial education, not making people feel smarter than the market, making them harder to exploit. Lesson 1. Costs compound. If you ignore them because they look small today, they may become the biggest silent expense of your investing life. Lesson 2. Average is not failure. In a high-cost world, low-cost average can beat expensive ambition. Lesson 3. Incentives matter. If the person selling you complexity gets paid more when you stay confused, confusion is not an accident. It is the business model. Lesson 4. Simplicity requires courage. It is harder than it sounds to ignore noise, avoid trends, and keep doing the boring thing for decades. Lesson 5. The goal is not to look smart. The goal is to build wealth. Sometimes the strategy that sounds least impressive at dinner is the one that works best in real life. That is the deep irony of Jack Bogle. He became a giant in finance by telling people they did not need most of the giants in finance. He did not promise genius. He promised arithmetic. He did not sell access. He sold fairness. He did not worship complexity. He attacked it, and because of that, millions of investors kept more of their money. Not because they became market wizards, but because they stopped feeding so much to the machine. The casino is still open. The lights are still flashing. The croupiers are still smiling. And Wall Street still has 1,000 new ways to make activity look intelligent. But now, the average investor knows there is another door. A quieter door. A cheaper door. A door built by a man who understood that time is your friend, but impulse is your enemy. The $10 trillion idea was not complicated. That is why it was so disruptive. Own the market, cut the costs, stay the course, let compounding work. Wall Street made investing feel like a game only insiders could win. Jack Bogle turned it into a system ordinary people could actually use. That is why the index fund changed investing. It did not make everyone rich overnight. It did something more practical. It gave ordinary investors a fairer fight. What do you think? Was Jack Bogle the most important investor advocate in history, or just the first person brave enough to say Wall Street's expensive game was broken? Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of the $10 trillion idea that changed investing, then you'll love the story of how Jim Simons outsmarted Wall Street. Click the video on your screen now. I'll see you there.